Sun Life AMC joining us on the show. Mahesh, hi, morning, and thanks so much for your time today. First up, just talking about how the market is open at 25,000 and above opening, so at least looking stable on that front. But what is your near to medium term outlook coming in for the market? Because lots of factors at play. You have the tariff situation, GST to be implemented from the 22nd. So amid all of this, and now we're approaching the end of the second quarter too, where do you believe the markets are headed in the medium term?
Yeah, good morning. So I think, in the last couple of months, we've seen a lot of events, unfold, and some of them negative, and like the trade deal. But GST has reforms, which were announced, and the rate cuts, to some extent negates that sentiment which was there because of the higher tariffs which were there. But if you look at on balance everything, I would say that, one fact is that Indian markets have significantly underperformed the global markets in a big way in this calendar year, right? We've seen markets are up around 25-30%, some of the Asian markets, and even the developed markets. So clearly there has been underperformance. So India's relative valuations, right, which was supposed to be higher, and that's for the reason why a lot of foreign selling we saw in the better part of this calendar year. I think that has to some extent bridged because of the Indian underperformance. Second is that the earnings growth, which deceleration, which started from the second quarter of last fiscal year, I think that has also now kind of bottoming out. And while this second quarter of this fiscal year might still be not that great, but I think the full impact of GST cuts and the uptick in demand on the consumer side, I think you will see the second half of this fiscal year, where the earnings growth trajectory should start to now improve again. And we expect it to get back into around 10 to 12% in that range in the second half. So I think that would be the real driver for the markets really to start moving up from here. And I think overall on the global front also, I think we are expecting now rate cuts with the US job data which has come in. I think the chances of rate cuts are now increased. And in this backdrop, I would say that you should see money again coming back into the Indian markets. But I think in the short-term markets would probably remain range-bound because Q2 numbers are also not likely to be that great. The disruptions which have caused because of the tariffs and also the GST also initially, there will be some amount of disruption. People who are holding back in expectation of a GST rate cuts. So all in all, I would say that it's going to be a kind of a range-bound market. But I think as we move into the second half, I think you will start gaining traction on the back of earnings growth.
Well, absolutely. And Mahesh, I was just reading your note talking about as to how with GST, Diwali is coming early. But, if you really draw down to the beneficiary sectors, Mahesh, sure, yes, autos could be one, definitely, given that they've already announced the pass-through come September 22nd. But it's largely small ticket items, footwear, white goods, apparel, QSR, etc. won't really translate into as much cheer for the equity markets per se, don't you think?
Yeah, so it's more about the sentiment, right? I think so. It's what happens is that when you see buoyancy, in the especially on the consumption side, and it will be across. I mean, even the FMCG sector also, which has been kind of been weak in terms of volume growth. I think that could also see some kind of an uptick over there, and which is again a large sector. So one is that the volume growth, but also I think as you see the volume picking up and the GST rate cut, I think there is some benefit on the margin front also, I think, which would flow through. So I would agree that it might not lead to a significant upgrade in terms of the earnings projections, what we have for this fiscal year. But even otherwise, I think the concern which was there that the growth in the economy, which is slowing down, while the first quarter GDP number growth was very strong on the real terms, but we all know that the nominal GDP growth has been weak at around 8.5%. So I think that lifts the sentiment in terms of the outlook here. At least the consumption piece, should give a leg up, and the confidence feeds into it, right? We are also expecting rate cuts to follow. I think there is now expectation of more rate cuts in India, considering where inflation is. So I think all that will, feed in, and I think that could at least ensure that the earnings downgrade cycle, what we've seen in the last couple of quarters, I think that gets arrested.
Right. Hi, Mahesh. Morning. This is Shrishti also joining in. But Mahesh, that's about consumption. But overall, the markets typically tend to price in growth way ahead of the actual numbers, while your overall estimates on the earning projection stands between 10 to 12%. If you can help us understand, which sectors do you believe can outpace this growth number, and where the investor confidence can also come in?
Yeah, so I think this year, I think the sectors, clearly, which I think when I say 10 to 12%, that is more on the second half. Overall, for the full year, I think we'll be more closer to around 9 to 10% kind of a growth is what we are looking at. And the sectors, I think, which will drive that is sectors like, for example, metals, cement, which are coming in from a lower base. I think that should do well. Pharmaceuticals, like especially domestic pharma, I think should be steady. We are also auto sector also, I think you should see, because of the GST cuts, I think that also should do well. I think we are expecting not only volume growth, but also margin improvement to follow in that sector. And then NBFC sector, which is likely to see now some benefit of the rate cut transmitting through. And if the retail, consumer durable and auto sector picks up, you will see the credit growth on the retail side also pick up in the second half. By and large, I think these are the sectors, which will drive even some of the industrials, especially in the power sector and the T&D sector, where there's a strong order book and execution that will also exhibit a strong growth. So these are some of the sectors. I think clearly banking will be a kind of a drag down for this year, which will grow in probably in mid-single digits because of the interest on net interest margins. But so I think it will not be a blockbuster in that sense, but these are some of the sectors I think which will probably do better than the overall average growth.
Okay, and Mahesh, what's your view on the entire banking and financial space? Because if you take a look at what the quarter one earnings looked like for most of them, the NIMs number was not very promising. Do you see that changing anytime soon, or should we wait for a few more quarters before expecting to see that?
So I think even this quarter also should be kind of muted for the banking sector. I think the one benefit, for the banking sector to play out still is the CRR rate cut. I think we should start now getting into the third quarter, and that should kind of offset the impact of the NIM compression which is there. And I think more importantly for the banking sector is the credit growth, which has been weak. If that picks up in the second half on the buoyancy on the retail side, I think then that could lead to improvement. But I think again we are expecting again second quarter also to be muted for the banking sector, and overall and if at all there is one more rate cut, which is most likely, I think it will be another couple of quarters before you could see an uptick in the earnings, at least for the banking sector. Having said that, the valuations there are fairly reasonable, so we don't expect any negative reaction because that's already priced in.
All right, but Mahesh, we can keep talking about the triggers that we have domestically, but the other number that we are keenly watching out for, one is the kind of fall that we have seen in rupee, and along with that the FIIs selling in the cash market. Even the GST announcement couldn't get that cheer back from the FIIs. You keep talking to so many investors day in and day out. Help us understand what's the sentiment looking like for India, especially from the FIIs.
Yeah, so I think one is FIIs. I think the sentiment has been negative, and there are two reasons. One is the relative growth for India has been weaker, especially in the last 12 months, and that's one of the primary reasons. Secondly was the valuation differential, right? India was looking expensive compared to some of the other emerging Asian as well as developed markets. So that was another reason. And then the rupee itself, the pressure on rupee because of the trade deal, which has the tariffs which were imposed. I think to some extent, I think the rupee depreciation has largely played out. And what happens is that as rupee depreciates, and we've seen a significant depreciation, not only vis-a-vis the dollar, but vis-a-vis some of the other emerging other currencies. It has around 8 to 10%. So that leads to somehow effect once it normalizes. It has actually a positive impact on earnings, because a lot of companies which are exporters, I think they tend to benefit over there. So I would say that the valuation differential has now narrowed down, because the India's underperformance which is there, and the growth concerns which were there. Earnings growth has been in the mid-single digits. Once that starts to improve, I think you will see foreign FIIs again start to come in. Mind you, FIIs ownership in Indian stock is at its lowest ever, what we've seen in the last 20 years. So there is little room for them to sell. It's a question of when they start coming into the markets.
Right. Okay. Mahesh, great to have you on the show. Thank you so much for taking the time out and speaking with us as always.
Thank you.
Okay, that's the view coming in on the equity markets. Let's move now and let's talk about what's happening with the steel sector. A lot of factors which are